With an AI bubble inflating, a new Fed chair coming, and the US-China relationship in an uneasy truce, certainty is in short supply. In The World in 2026, Capital Economics highlights the key risks and opportunities in the year ahead. These written reports, virtual briefings, and in-person meetings give decision-makers critical insight for what's bound to be another challenging year in global macro and markets. Check out The World in 2026 at capitaleconomics.com today.
It's December 12th, and this is a special episode of the weekly briefing from Capital Economics. I'm David Wilder, and it's that most wonderful time of the year when analysts gift clients with their outlooks for the coming 12 months. The team at Capital Economics has been assessing and briefing clients around the world in recent weeks about what we think are going to be the main drivers of global macro in 2026. And I sat down with Group Chief Economist Neil Shearing and Jennifer McKeown, our Chief Global Economist, earlier this week to get a sense of what they've been telling clients about what to expect in the coming year. And here's that conversation now. Let's start with you. What kind of year can we expect in 2026? Because coming into 25, there was a lot of, frankly, hysteria around what was coming up, particularly given regime change in Washington. And it felt like a lot of what you and the team were doing was counseling and saying, it's going to be okay. It's not going to be great, but it's going to be okay on a sort of macro level. And that is how the year has basically panned out, despite the news flow and all the volatility around that. So set the tone for us in 2026. What can we expect given the year we've just had?
Yes, I was looking back and we characterised this time last year as 2025 would be a year of muddling through, was the term we used. It feels about right to me. It feels like we have kind of muddled through. Things have not been quite as bad as many had assumed they would be, but equally, the US economy, global economy has not gone to the races as some that were particularly optimistic about the Trump agenda thought that it might. And I think 2026 is going to be more of the same, frankly, another year of muddling through at a global level. So if you look at our global GDP forecast, is about 2.75% GDP growth next year. That's below the recent historical average of 3%, but it's not a disaster, frankly, in the circumstances. So I think the more interesting stories next year are going to play out, not at a big global macro level, but I suspect at a country level. If you look at our GDP forecast, our growth forecast for the US, they're more bullish than the consensus. So we've got 2.5% GDP growth for the US next year. That's predicated on a belief that the AI investment boom has further to run and that we'll get a pickup in productivity growth, not necessarily driven by AI, but a pickup in productivity growth, even coming alongside of squeezing the labour market in the labour supply. So that sustains GDP growth in the US. Set against that, however, we have a continuation of weak growth in China, 3% on our CAP measure of GDP growth in China next year, and persistent deflation, and not much in the way of major reforms coming out of the 5-year plan in March, and softer growth or below consensus growth in Europe too. So the Eurozone growing by just 1% next year. And so when you think about how that plays out in terms of monetary policy, we have the Fed cutting by less than markets expect over the next 12 months, and the Bank of England and the ECB cutting by a bit more than markets currently anticipate.
Jenny, Neil touched on AI there, on the impact of AI, particularly on the US economy. Is that a US story? That US 2.5% growth number does jump out. So is AI going to be a dominant global story next year, or is it still very much about what's happening in the US?
Well, it will definitely be a dominant story. Everybody's interested in AI, aren't they? And obviously what's going on in the equity market will continue to draw a lot of attention. I think so far as the macroeconomic effects are concerned, though, the US will continue to very much lead that. We'd long argued that the US would lead the AI revolution. And if we look at the GDP data, the investment data, it's very clear that the ICT industries have been a really key driver of GDP growth in the US this year and of investment in particular. If we look elsewhere, though, particularly around the Eurozone, you can't really see any evidence of that. Things like imports of ICT components have been surging in the US, whereas they've really not picked up across the Eurozone. So I think the AI story is a reason to expect the US to continue to outperform over 2026. We certainly wouldn't expect Europe to be experiencing anything like those 2.5% GDP growth rates that you've mentioned. One area to watch, of course, is China, where the economy does seem to be catching up to some extent in terms of AI. The performance of its top large language models seems to be gaining on that of those in the US. And of course, new access to chips might help that to some extent. So we would expect AI to be a part of a growth story in China over the course of the coming year. But I think the important point to point out is first that China's focus is still very much on industrial policy and in parts on traditional parts of industry, but also that China is unlikely to see the extent of productivity gains from AI that we expect the US to experience. One reason for that is that the Chinese government will be encouraging investment in AI and directing investment in AI, even where it's not efficient. And also state-owned enterprises will be pressured to avoid layoffs, which will limit the productivity gains from AI.
So I was going to stick the question about macro risks to the end, but it feels like I can ask now, back on the US, given that we have this view about the market bubble around AI continuing to inflate in 2026 and not popping until sometime in 27, obviously there is a risk, isn't there, that bubble bursts sooner. And if it does, given how AI has been driving US growth, given the wealth effects from a rising stock market, what would happen to the economy if the bubble does burst in 2026?
Yeah, it's always a risk in a situation like the one we're in now, where assets have become very highly valued, that you get this correction, and there may well be spillovers to the macroeconomy. But those depend a lot on the situation under which the correction happens. I think we're relatively sanguine about the likelihood that a correction has major macroeconomic effects for a few reasons, really. One is that the economic benefits of AI should continue even if equity prices fall, because the technology will still be valuable and still be boosting economic activity. And that would be something like we saw after the dot-com bubble, although that bubble burst and there were some spillovers to the macroeconomy. The internet was still very valuable and still boosted growth. A second reason is that financial spillovers might be limited by the nature of financing of this AI boom. So far, it's been financed largely out of earnings, and aside from that, backed by established giants with deep pockets. So that's a big contrast to the global financial crisis, for example, where securities were backed by stretched households who couldn't afford mortgage payments. And then a third reason is that we're currently in an environment of largely of monetary policy loosening rather than of tightening, and there is some scope for central banks to cut interest rates further. There was a recession after the dot-com boom burst, but that was largely brought about by a substantial tightening of monetary policy in 1999 and 2000. We don't expect that to happen this time around. Now, if any of those things change, you could be looking at much worse economic effects, but those are some reasons not to be too worried for now.
But it is that point, isn't it, that asset bubbles, they inflate, they burst. We've seen that through history. They're associated with economic downturns immediately after, in some cases, but that depends on the sort of the macro environment, the policy environment in which those bubbles burst.
Yeah, it does. And if the bursting of the bubble is caused by, say, a sharp tightening of monetary policy because commodity prices are surging, then yes, you get economic effects at that stage because some of the drivers are the same. So the tightening would be causing a downturn in the economy as well. So it depends a lot on the environment, as you say.
We talk about AI very optimistically, but the fact is that at the moment, the companies doing best out of AI are the ones selling the hardware. do we see a risk that the benefits of AI, the productivity benefits of AI, don't actually come through to the extent that we're forecasting, because we're still trying to figure out, and there are still a lot of unknowns about this technology, but we're still trying to figure out how AI can be used most effectively to improve productivity.
Yes, of course, you're right. We're in uncharted territory here, really. So it is difficult to judge exactly what is going to happen. But there is some relatively encouraging evidence which we've been watching. For example, if we look at the share of firms planning to use AI in the next 6 months, particularly in the US, we can see that that's risen pretty significantly and that it's spreading to the sectors, not just very directly related to AI, but to areas that could see the clearest potential benefits. Those include things like professional services, finance, education, real estate, so that there is a spread, and we do expect the productivity benefits to spread, particularly in the US. But there's always something of a risk that at least some parts of AI turn out to be disappointing, and that would mean that the future productivity gains would disappoint too, as well as the likelihood that triggers a correction in the equity market.
Neil, to what extent is 2026 going to still be about Trump's trade agenda, the impact of tariffs on the global economy, the threat of more tariffs on the global economy? Is that a 2025 story, or are we going to see more of that in 26?
Well, I think there's two aspects to that question. There's Trump and trade and tariffs, and there's the US and China relationship, with two slightly distinct things. So let's take each of those in turn. On Trump and trade and tariffs, I mean, we made the point at the start of this year that we thought that tariffs would increase by more than markets were anticipating, but that they wouldn't deal a fatal blow to the global trading system. In fact, we had global trade volumes edging a little bit higher over the course of this year, and that's broadly what's come to pass. What 2025 has illustrated is the extent to which the global trading system is extremely adaptable, flexible in the face of these tariffs. And I think that will be a continued theme that will continue to play out in 2026. Now, on the US-China relationship itself, there's been a clear move over the past 6 weeks or so, since really that Trump-Xi meeting at the back end of October, towards much warmer relations between Beijing and Washington. And from the outside looking in, a lot of that seems actually to be driven by Trump himself. There seems to be a particular push by Trump to thaw relations with Xi, and potentially a meeting in Beijing, Trump visiting Beijing in April, we're told. So my sense is that we're going to see over the first half of next year possibly a further warming of relations as potentially we build towards this this summit that's been talked about in the springtime. Now, the question I think, though, is does that really amount to a fundamental reset of relations between the US and China? And on that front, I'm far more doubtful. I think it's really striking that the agreement that was struck between Xi and Trump at the back end of October had a 12-month sunset clause, so we've got to come back into the back end in October 2026, and that will be renegotiated. The fundamental sources of tensions between the US and China that have manifested itself in this deepening superpower rivalry have not gone away. And then, if anything, actually, I think China's challenge to the global trading system, and to get to the fact of trade, has intensified over the past 12 months or so. If you look at the sheer magnitude of China's trade surplus now, $1 trillion in November, that is posing a massive challenge to the global trading system, and it has its roots in China's excess savings rate, depressed rates of consumption, overinvestment, and price cuts in the export sector that's shipping volume overseas. And I think there's no sign, as far as I can discern, that any of that's going to change in 2026. So yes, I think we might see a move towards warmer relations, or further warming of relations between the US and China over the coming months in the first part of 2026. But fundamentally, those sources of tension, including on the trade front, have not gone away. So I don't think this is a lasting détente, and there's any number of potential flashpoints that could emerge over the course of next year.
And as you say, it's very much quite understandably framed as US-China competition, these two superpowers. But when we think about Chinese industrial policy and the reflection of that in this huge trade surplus number, it's a China versus rest of the world story in some respects, isn't it? Where does this go? Where does the threat posed by China's dominance in manufacturing, where does it take us in 26 in terms of Chinese economic relations with the rest of the world?
Well, I think it's a relatively difficult place. I don't think we're going to get there very quickly, by the way. I think this is a slow burn issue that's going to play out over many years. But I think a simple way of thinking about what's happened over the past year or so, a stylized way of thinking about it, is that the US consumes more than it produces and China produces more than it consumes. And previously that manifested itself in a large bilateral deficit between the US and China. Then Trump comes along, slaps on big tariffs on China. We've seen a big collapse in the US's bilateral deficit, trade deficit with China. However, that has not been matched by a collapse in the US's overall trade deficit, nor has it been matched by a collapse in China's overall trade surplus. So what's really happening, I think, is that the US is providing demand to the rest of the world, and the rest of the world is providing demand to China. And we're still left in a situation where the US, frankly, is over-consuming and China is under-consuming. And this is the fundamental tension within the global economy. And that Chinese overproduction and underconsumption, the safety valve has become the other parts of the global economy rather than the US. And so my sense is that what we'll see over the next 12 months in 2026 and beyond is other countries starting to push back against Chinese overcapacity and overproduction. So we're already seeing now, if you look at the data, China's trade surplus with emerging economies is now greater than it is with developed economies. So potentially we might start to see some other large emerging economies pushing back against flood of cheap Chinese imports. I think we'll see Europe pushing back against China in certain sectors, mainly on the grounds of economic competition, not so much on national security like the US, but the mainly economic competition. And then the final point, I think, is how other countries respond to the idea that they might be turned into kind of third-party trading posts for shipping Chinese production into the US kind of at lower tariff rates through the back door, as it were. This rerouting of trade that's been a central feature of the global economy over the past 5 years or so. And my view is that countries are going to start to push back on that. We are going to see the middle part of next year, a renegotiation of USMCA, the agreement between the US, Canada, and Mexico, the trade agreement. It wouldn't surprise me to see as part of that a tightening of rules of origin that basically require tariff-free goods to have a certain element of production within North America, but again, aimed at pushing back against Chinese efforts to ship to the US through Mexico at lower tariff rates. So yeah, I think 2026 will be characterized by further gradual pushback from the rest of the world against Chinese imports.
Jenny, thinking again about risks, there has been this notable shift in pricing in the bond market, where it seems that more and more investors are now looking at not just fewer rate cuts perhaps than had previously been expected in 26, but actually that we might start seeing rate hikes in 2026. And most notably, I think, is the idea that the ECB could be raising rates in 26, according to the government bond market. I mean, what's the risk there? What's happening in the bond market, and how does that feed into what we're expecting?
Yeah, well, this is really interesting, isn't it? There does seem to have been a bit of a shift in sentiment in markets recently, particularly regarding the outlook for monetary policy. Previously, when we've seen bond yields rising, kind of in recent experience, that's been about fiscal concerns. But that doesn't seem to be the driver now. It's more an underlying reassessment of the policy outlook. In some cases, we think that's warranted. If we look across the advanced economies, we are expecting the Reserve Bank of Australia, for example, to hike interest rates next year, the Riksbank too, towards the end of the year in Sweden. But in other cases, we don't think that it's warranted, and we think there's likely to be something of a reversal of these bond market moves, particularly in Europe. You mentioned the ECB. We don't think the ECB is going to be hiking interest rates next year. If we look at the labour market in particular and leading indicators of wage growth, they all point down. And we think that underlying inflation is going to continue edging down next year, and that ultimately the ECB is more likely to cut interest rates next year than to raise them. And something similar applies in the UK, actually.
So for Europe and the UK at least, do you think that the whole inflation battle is basically done and dusted?
Yes, I think it probably is. If we look at both of those economies, growth is still very soft, and there's no evidence that they are running hot. Those economies, no real reason to expect inflation to be picking up. And at the same time, the employment is very weak. And if we look at broader measures of labour market activity, such as vacancy rates, that they all point to relatively loose labour markets, which should continue that trend of weakening wage growth. In the UK's case, too, interest rates are still relatively high. The level is still relatively restrictive. So all else equal, the Bank of England should really be looking to normalise interest rates.
Neil, what about the Fed? We had what's been called a hawkish cut in recent days. That was the outcome of the last FOMC meeting of the year. But Donald Trump is expected to announce his nomination for the next Fed chair soon, isn't he? So he's been shopping around for someone who's basically going to deliver the massive rate cuts he's been calling for, well, since he came back into office. So how is the Fed going to square this circle? What's the outlook for US monetary policy in 26?
Well, it's a pretty big circle to square if, as Trump suggested in an interview over the past week, we should have GDP growth of 25% a year. I'm not sure the Fed's going to be capable of doing that. I'm not even sure really whether there's going to be a majority on the Fed's board to cut rates as aggressively as even the markets are pricing in at the moment. So if you think about our macro forecast for the US, 2.5% GDP growth over 2026, core PCE inflation continuing around that 3% range for the time being, the labour market softening and hiring softening, but there being a squeeze on the supply side of the labour market too, so that we don't get a big rise in unemployment. And on top of all of that, the fiscal deficit running at 6% of GDP and potentially even more if the Supreme Court rules against Trump's tariffs and the federal government is forced to repay some of those. So all of that suggests to me there's not a great deal of need for enormous monetary accommodation. I think what we've seen so far is the Fed cutting rates, trying to get out of restrictive territory back towards something approaching neutral. I think we're pretty much there now. We've got one more rate cut in our profile for June. That's more of a signal, I think, once the new Fed chair is in place. But I don't think there's going to be much room for that Fed chair and the FOMC more generally to cut rates very aggressively. Now, the one risk is that we do get a more unorthodox Fed chair, and over time they start to shift views on the FOMC more generally. But I think at this stage, we're viewing that as a risk of the forecast rather than the central view.
So safe to say that Trump is probably going to remain dissatisfied with the Fed in the coming year.
I think we're going to get lots of carping from the sidelines. The president's likely to be dissatisfied over the coming year. Certainly if what he's aiming for is 25% GDP growth, fueled by monetary accommodation, then I think that's one of the safer forecasts we can make in the coming year that it's not going to happen.
Jenny, I wanted to just go back to what you were saying about how the bond market's focus has shifted from fiscal concerns. Again, thinking about what could go wrong in 2026, it's been such a dominant theme, if at varying degrees of intensity over 2025 and actually over 24. How do we gauge the threat from the public debt situations of all of these governments in 2026? Because even if the bond market's focus may have shifted, the fact is that these underlying issues haven't gone away, have they?
No, they absolutely haven't, and they won't go away in the course of 2026 either. It's pretty clear across a number of advanced economies that public finances are on perilous ground. Debt trajectories are clearly upward, and markets are very aware of that. And it's likely we'll continue to see volatility in markets, probably around political events, really. The UK, of course, isn't out of the woods, although Rachel Reeves' budget measures have doubled her fiscal headroom. There are now questions about how long she's going to stay in position, along with our Prime Minister, Keir Starmer. So if they were replaced by leaders who were more inclined to raise welfare spending further in particular, then markets would respond badly to that, I think. France is perhaps the biggest risk. Actually, it's still stuck in a political stalemate. It's unable to pass the austerity that is really needed there, given its debt and deficit positions. And we have an election coming up, a presidential election in France in 2027. So in the run-up to that, If it looks more likely that France will elect a populist far-right president, which is already quite possible, then depending on what the potential president is saying about the prospect of fiscal tightening or indeed renewed fiscal loosening, and then the markets could also respond quite poorly. We suspect that France is going to come under renewed fiscal scrutiny next year, and that yield spreads will rise again.
What about the US in 2026?
The US is a bit of a special case given its reserve currency status, which just creates an underlying demand for its assets. But it's definitely not immune to market concern. As we've seen this year, its large budget deficit is entirely structural. It's not been driven by the economic situation, which is actually pretty good. So it's actually going to require some action by Congress to correct that deficit. And it doesn't seem like that's going to happen in the foreseeable future. There are a few potential flashpoints that might cause some renewed market concern in the US over the course of 2026. One might be the Supreme Court ruling regarding tariffs. If they're overturned, that would blow a hole in the public finances, which would be very difficult to address. And of course, it's also likely that concerns over the debt ceiling will crop up again. We've all got used to that, but it does tend to cause flashpoints as and when these arise.
We've heard lots about risk, things that could go wrong in 2026. Neil, give us some potential good news. Are there upside risks to watch for next year?
It does feel, doesn't it, sometimes the good news is thin on the ground. I mean, one general point I would make, in fact, I made it in a note that published over the past week, is that economies do have a habit of being a bit more resilient than economists in particular tend to assume. It's the normal state for economies to grow. So yes, some of our forecasts are a bit below consensus, but we don't see widespread recessions or in any major economy. So I think that to some extent, I think our glasses should be half full. Potential piece of good news in the UK is that inflation, I think, might fall a bit further, a bit faster than the markets, the Bank of England is expecting. So for those of us based in the UK, some potential light at the end of what's been a very long inflation tunnel. And then I guess that the big question would be, Jenny spoke a bit about how the benefits of AI will be, for now, concentrated in the US. But over time, we expect that to spread to other countries. Very difficult to say when that happens and what triggers it, but it's possible that we start to see some of that benefit spread out in other countries next year. That would be the kind of real game changer, as it were.
That was Neil Shearing and Jennifer McKeown on the big macro themes and risks to watch in 2026. I will post a link to our dedicated World in 2026 page in the podcast notes. Watch out in the coming year for more insight into those big themes: AI, US-China, China policy, fiscal risks, monetary cycles, regime change at the Fed. To get to grips with these massively complex issues and make sure you're getting the full picture, you need all access to our insight, our data, and to our Economist team. That's why we created CE Essential and CE Advanced, our all-access packages. Find out how Essential and Advanced can help your decision-making today. Get in touch to learn more at sales@capitaleconomics.com. That's sales@capitaleconomics.com. I'll be back next week talking to the team about the financial markets outlook in 2026, as well as a review of the ECB and Bank of England meetings. Until then, goodbye.